What's up guys, welcome back to the Momentum Trading Lab, and in today's video I'm going to go over one of the most important concepts that I use in my day-to-day trading, and that is liquidity. So why is it so important to understand liquidity? So price action tends to move between liquidity and imbalances on a time-based schedule. So understanding liquidity can give you your edge in the market. The other important reason for understanding liquidity is the big money players can only enter the market whenever price action enters one of these significant liquidity pools, and these liquidity pools are normally in the form of retail stop losses. So the big money players can only enter the market whenever the retail traders get stopped out. Okay, now that we know liquidity is important, let's actually look at how to identify liquidity. So there's two types of liquidity. You have buy side liquidity and sell side liquidity. So the buy side liquidity is found above old swing highs or relative equal highs. And this is where retail traders will put their stop losses when they go short. And for sell side liquidity, that is found below swing lows or relative equal lows. And that is basically where retail traders will put their stop losses for their long positions. So if we look at this little diagram, above all highs or relative equal highs is where the buy side liquidity resides, and below old lows or relative equal lows, that is where the sell side liquidity resides. So let's quickly discuss why they call it buy side and sell side liquidity. So let's start with the buy side. If a trader goes short and he puts his stop loss above these highs and price action triggers that stop loss, that trader needs to buy to cover that short position. And then on the sell side, if a trader goes long and puts his stop loss below these lows, and that stop loss gets triggered, the trader will sell to cover its position. So that's why it's called sell side and buy side. Okay, this is a continuation from the previous slide. So for buy side liquidity, that can be found above relative equal highs, also known as double top. So if a trader goes short based on this double top idea, it's very likely that the stop loss for that position will be placed above these highs, so somewhere in that area. And then the same for a swing high. If somebody goes short right here, it's very likely the stop will be placed above this high. So that is where you find the buy side liquidity. Sell side liquidity is found below relative equal lows or double bottom. So if someone goes long based off this double bottom idea, it is very likely that the stop loss for that position will be placed below these lows, so somewhere in this area. And then the same for the swing low. If someone goes long based off this idea, it's very likely that the stop loss will be placed below this low. So that is where you find the sell side and buy side liquidity pools. Okay, let's look at the NASDAQ for a couple of examples. So right here we have a swing high, right? So on this candle we have a high, and on either side we have lower highs. So that is a confirmed swing high. So above swing highs we have buy side liquidity, and I like just labeling it like this: buy side liquidity. Okay, so we know that the algorithm likes to attack the liquidity and then reverse in the real direction. So let's see how this plays out. Okay, so right there, it tapped into the liquidity. You can see it did not displace above this high. It's just tapping in there and getting rejected. So let's see what happens. And then right there, we get the displacement to the downside, which created that fair value gap. And this is how I use the liquidity. So I first wait for a rate on liquidity, then a market structure shift, which we are seeing right here. Actually, it happened right there. So there we have a low. On either side of the candle, we have higher lows. So that is a confirmed low right there. So we displaced below this low, fair value gap. So then we can frame a short idea if price action retraces back into this fair value gap. Or you can also look at this breaker block right there. So there's different ideas on how to enter. But the main thing is that you want to see that rate on liquidity first before you start thinking about entering any trades. So that was an example of buy side liquidity. Okay, here we have an example of a double top or relative equal highs. So that is the relative equal highs. So that will look like a pretty good spot for a trader to put his stop loss if he decides to go short for instance, on this leg down. So let's mark this off buy side liquidity. And let's say our price action reacts once it gets to that level. So we just want to see tap into it and then displace to the downside. If the displacement is to the upside above this high, then it's likely that the bullish market structure will continue. So let's see how the price action reacts once we get to that level. All right, so see it poked into that level, then got rejected. So a larger player or big money basically bought up all of the stops in this area. So basically went short in this area. And then we got the displacement below the low for the bearish market structure shift. And then it also created the fair value gap that you would want to see. Okay, next up, we are going to look at sell side liquidity. So right here on the daily chart, we have a swing low right here. So we will have the sell side liquidity below this low. So we want to see price action. Once it gets into this area, we want to see it just tap into it and then start to aggressively move away. That will tell us that a bigger player bought up all of these sell stops below this low. And now it will be likely that we should see higher prices for the NASDAQ. So let's see what happens when price action gets into that liquidity pool. The seer just taps into it and then aggressively starts to move away. And see it went straight to the buy side. So price action tends to move between liquidity pools and imbalances, and it moves between sell side and buy side liquidity. Okay, in this example, we'll look at the relative equal lows. So right here, we have these relative equal lows. So we know that we have sell side liquidity below these lows. Let's mark this as sell side liquidity. Extend this a little bit. So let's see what happens when price action retraces to this level. Okay, so see we are tapping right into that liquidity pool, not displacing to the downside. So let's see how this plays out. Then it starts to aggressively move back to the upside. That has been my explanation on sell side and buy side liquidity. I hope you enjoyed this video. If this video provided you with any value, please consider hitting that like and subscribe, and I'll see you guys in the next one.